Good evening, everyone. My name is Dr. Tisa Silver Kennedy, and I'd like to welcome you to the April 27th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. Let's get right into this evening's questions. But first, I want to tell you a bit about the Maryland Center for Collegiate Financial Wellness, then a bit about office hours. And from there, I'm going to share with you answers to lots of questions from our community. For this edition, the questions have centered around income-driven repayment plans, public service loan forgiveness, and the limited PSLF waiver. If you have questions at any point in time, please do feel free to leave them in the chat if you're joining me tonight via Zoom, or you can drop those questions into the comment space on Facebook as we are running the broadcast live through Facebook. So, a bit about the Maryland Center for Collegiate Financial Wellness. We are a new organization founded in July of 2021. We are helping students build financial life skills and empowering them to thrive. We have an ambitious vision for all of Maryland's college and career school students based on 6 pillars that we've identified in financial wellness. I'm not going to read through all the words for you. You can read the descriptions if you like online at our website, mccfw.org. But I did want to share with you tonight that our vision includes these 6 pillars, which are: first, being creditworthy; second, ready; third, resilient; fourth, empowered; fifth, successful; and sixth, and finally, thriving. So again, if you'd like to know more about our vision or the center in general, you can visit us online at mccfw.org. Again, that's mccfw.org. One of our programs is Office Hours. Office Hours is a free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. I must tell you, though, that the information that I share with you tonight during office hours is just that. It's for informational purposes only. It should not be construed as financial or legal advice. My hope is that you will pay attention to the information and the resources shared during tonight's edition of Office Hours, but then you will go back and take inventory of your student loans, your personal finances, and resources from other trusted venues, and you'll combine that information to make the decision that makes the most sense for you in your financial circumstances. So now that that's out of the way, let's go ahead and one more thing I wanted to share with you before we get to the questions, and that is that we are in the middle of a statewide campaign called MD-TAPS, and MD-TAPS stands for Maryland Tell a Public Servant, and we're specifically asking people to tell a public servant about PSLF. That stands for Public Service Loan Forgiveness. The Public Service Loan Forgiveness Program has been out for quite some time. However, there were some changes made to the program in October 2021 that have allowed thousands more borrowers to achieve student loan forgiveness, and that's tax-free student loan forgiveness, and it's helping others get closer. So if you could join us in that campaign, I would greatly appreciate it. Any information that you hear tonight that you think would be useful, please do feel free to share it online using the hashtag MDTAPS. That's MDTAPS. Again, that stands for Maryland Tell a Public Servant. We've embarked upon this campaign to spread awareness about a time-sensitive opportunity that can bring public servants closer to realizing federal student loan forgiveness. And you can visit us online at mccfw.org/MDTAPS for details. We've built a robust resource page to give information about eligibility and next steps. So please visit us online at mccfw.org/MDTAPS. and tell anyone who you think might be able to benefit from the information that's included. All right, now we can jump right into our questions. The first question is, I heard something about forbearances being reevaluated for IDR. What is that about? Well, that's a short question, but a loaded question. So first, I want to begin by explaining what IDR stands for. IDR stands for Income-Driven Repayment Plans. Income-driven repayment plans are plans where the borrower's monthly payment is based on that particular borrower's income and related factors. The borrower usually has to answer questions about their adjusted gross income, the number of dependents they have, their state of residency, and their tax filing status. or the borrower can give their servicer permission to pull that information from their most recent tax transcript through the IRS. Either way, income-driven repayment plans are based on the borrower's income and household factors. Another feature of income-driven repayment plans is that they're supposed to offer cancellation of the remaining balance after a borrower has made monthly payments for at least 20 years. But there are a lot of details that come along with that offer of cancellation. The first one is that there are several income-driven repayment plans, and I provided a chart here for you that lists those plans. First, there's income-based repayment, and there's also an income-based repayment version for new borrowers. Those are people who borrowed after July 2014. Next, there's income contingent repayment. Then there's pay-as-you-earn and revised pay-as-you-earn. And next to each of those repayment plans, you can see the terms for cancellation. So with income-based repayment, as I mentioned, there are two varieties of IBR. With IBR for new borrowers, cancellation can come after the borrower has made monthly payments for 20 years. The older version of IBR offered cancellation after a borrower had made payments for 25 years. If we move on to income contingent repayment, which is known as ICR, ICR offers cancellation after making payments for 25 years. Pay-as-you-earn offers cancellation after 20 years, and then revised pay-as-you-earn offers cancellation after 20 years of payments on loans that were taken out for undergraduate programs. But for graduate and professional students, if you borrowed loans during your graduate or professional experience, then repay, that plan would offer cancellation on the graduate loans after 25 years of repayment. So bottom line is all of these income-driven repayment plans include in them a provision that is supposed to provide cancellation after the borrower has made payments for the times listed that you see here with the corresponding repayment plans. Unfortunately, things have not quite panned out the way that they were supposed to. So I want to share with you an update about what happened and why you're seeing IDR in the news. So from a report published by the National Consumer Law Center and the Student Borrower Protection Center in March of 2001, approximately 8 million borrowers were enrolled in these income-driven repayment plans. However, a review of their progress toward cancellation showed that of the millions of borrowers who are enrolled in IDR plans, and I believe the estimate was that there were 4.4 million people who had paid through these IDR plans for at least 20 years. Of those millions of borrowers, just 32 were able to have their loans canceled through income-driven repayment. So 8 million borrowers out there, about 4.4 million enrolled in income-driven repayment plans, but only 32 of them were able to have their loans canceled under IDR. Obviously, that means there were some unfortunate things going on, to say the least, and the Department of Education has made an announcement acknowledging some failures of the program. So the Department of Education is currently taking steps to address what they refer to as historical failures in the administration of the federal student loan programs. And I've listed for you the actions, the steps the Department of Education is going to take in the coming months and years, and we'll just walk through them one by one. The first one is that the Department of Education will conduct a one-time account adjustment to count certain long-term forbearances toward IDR and public service loan forgiveness. This is where the action relates to the question that this borrower asked about forbearances in particular. A forbearance is a pause in your student loan payments. It's usually a pause that the borrower has initiated. It could be due to economic hardship, just not having enough money to make the payments and reaching out to the servicer and asking for a temporary pause in payments. Unfortunately, during those types of forbearances, interest is still accruing on the debt, so it becomes more and more expensive over time. The exception here is the CARES Act forbearance. This is the forbearance that went into effect in March of 2020, and that forbearance has allowed myself and many other borrowers to not have a payment due since March of 2020. It's also meant that our student loans, our federal student loans, are not accruing interest. But this particular review is not talking about the CARES Act forbearance. This is talking about the typical forbearance this borrower initiated. And it was also found that some borrowers were pushed or urged into forbearance through a practice called forbearance steering. And they ended up in forbearance for longer than the Department of Education's rules allow. So as a result of those actions on the part of servicers, the department is conducting this account review to go back and look at the counts and to also go back and look at those long-term forbearances that should not have happened per the Department of Education's rules, and counting some of those months toward credit for income-driven repayment and PSLF forgiveness. The second action that they're going to take is, of course, increasing oversight of servicers' forbearance use, because if all they did was just a one-time account adjustment, then it's possible that the same practices could continue. So that's why there's increasing oversight of servicers' use of forbearances included as well. The third step is to track progress toward IDR forgiveness. The reports also revealed that many servicers were not actually tracking the number of payments that borrowers had made toward cancellation through the income-driven repayment program. So they are going to begin tracking progress. The fourth step is to conduct a one-time revision of IDR payments to address past inaccuracies. So that's right in line with the one-time account adjustment, going back to review those records of past payments to make sure that they are indeed accurate and people can be brought up to the correct progress point and be able to accurately measure how many months or years of credit they have toward IDR and PSLF. And their fifth action is to permanently fix IDR payment counting by reforming FSA's IDR tracking. So lots of emphasis here on tracking those payments so that borrowers can have an accurate picture of where they are on that timeline, whether they're seeking cancellation through IDR or through public service loan forgiveness. So a bit more about IDR. I know when people hear things like that, there's a one-time account adjustment, they're going to review things, they're going to update my account. You want to know, well, how long is this going to take? This is a complex process. So according to federal student aid, they will begin implementing the changes immediately. But on the borrower side, you may not see the effect reflected in your account until the last quarter of 2022. So action is being taken. But again, this is not an easy undertaking, so it may take several months before you see the effects of these changes within your account. As for how many people can be impacted by these changes, I just wanted to share with you some estimates from the Office of Federal Student Aid. They provided three. The first is that at least 40,000 borrowers could see immediate cancellation via public service loan forgiveness. The second is that several thousand more borrowers with older loans will receive forgiveness through income-driven repayment, and that cancellation benefit that comes after 20 or 25 years, depending on which repayment plan you were using. The last point is that it's estimated that more than 3.6 million borrowers will also receive at least 3 years of additional credit toward cancellation through IDR. So after these reviews have been completed and payment counts have been updated, we expect to see millions of people get closer to that mark of being able to have their debt canceled through IDR, and some people even reaping the benefit of forgiveness through the public service loan forgiveness program immediately. So lots of changes in the IDR space. All right, so I mentioned PSLF, and that actually is a great segue into our next question. Please explain this PSLF payment count. And the borrower has provided the following details. Their PSLF eligible payments are recorded as 112. Their PSLF qualifying payments are listed as 39. Their PSLF qualifying payments remaining are listed at 81. And they have an estimated eligibility date for PSLF of June 2026. So a lot of people have questions on this subject and they want to know what is going on with the math. So I just wanted to share a bit with you about PSLF payment counts and where they come from. So if you've ever received a PSLF payment count letter, you're going to see a table that has several numbers included in it. The first one that you'll see is the PSLF eligible payments. Certifying your employment will close the gap between eligible and qualifying payments. So under PSLF qualifying payments, these are the payments that actually track how much progress you had toward the 120 that are necessary for public service loan forgiveness. So this borrower has 39 payments toward the 120. The next column beside PSLF qualifying payments is PSLF qualifying payments remaining. In this case, the borrower has 81. And if we look at the math and how this is supposed to add up, your qualifying payments plus your qualifying payments remaining should add up to be 120. And in this case, you see the big check mark because the math is working. 39 plus 81 equals 120. Now, if we move to the next section, the borrower saw estimated eligibility date for PSLF. And the date listed on this borrower's letter was June of 2026. So in terms of how this math works, this is just my thought process for how the math should work. We would look at the date that the letter was sent, and this was April of 2022. Assuming that or March of 2022 was the final month that's already been qualified, we would go to the PSLF qualifying payments remaining and basically tack on 81 months to that month of the last qualifying payment. 81 months out from March or April of 2022 would put this particular borrower at having made the 120th payment around January or February of 2029. So the estimated eligibility date for PSLF based on that number of qualifying payments remaining, it comes out to be early 2029, but the estimated eligibility date that's included in the borrower's letter is June of 2026. So that's why you see the big question mark, because something about those numbers is just not adding up. So it could be that the that the servicer has additional months to shift from eligible to qualifying because of employment certifications. But again, this is what creates some confusion amongst borrowers, because they're looking at the numbers and just plotting out the 120 months in their minds and trying to figure out exactly when they'll reach the finish line. And then when they look at a table with the numbers, they don't quite add up. All of the numbers don't work together in a way that makes having a definitive answer possible. So my answer for this particular borrower will be, if you have 112 eligible payments, that means you have 112 payments that were made on time, in full, and through a qualifying repayment plan. That means that what's left to do is for the servicer or the Department of Education to match those eligible payments with months of certifying employment. So if you have worked for a qualifying employer for that entire time, then I would expect the gap between 39 and 112 to close. That is, if you have worked for a qualifying employer the entire time, the gap between the 39 and 112 should close, and your true number should be 112 qualifying payments. And again, that is if you're able to certify your employment for all of those PSLF eligible payments. So if you do that and you get to the 112, that means you've got about 8 months left instead of having to wait until January or February of 2029. So for those of you that have these payment counts that just aren't making sense to you, I would encourage you to just wait a bit, because there are many times when your payment count is still a work in progress. And if you log on to the servicer's online portal, they will often have a note there that says that your payment assessment is still a work in progress. That lets you know that updates will be made and that the numbers that you're looking at are not final. So in this case, I totally understand why the borrower needed some help kind of interpreting this. But again, I'm hopeful for this situation because there are 112 eligible payments, And if there is employment to match all of those months, then this borrower should go from 39 qualifying payments up to 112, and therefore just 8 months away from that 120th payment necessary to achieve public service loan forgiveness. So a quick notes on the payment counts. As for the updates, you can log into the online portal for the current PSLF servicer, which is Fed Loan Servicing. Their website is myfedloan.org, and check for updates to your payment counts, or also that note that the payment assessment is still a work in progress. The second suggestion I have for you is, if you've logged on repeatedly, maybe it's been several months since you submitted your form, and you're still not seeing an update and you just can't shake it, then I would suggest calling the servicer. You may experience a long wait time on hold because there are lots of other people who are feeling the exact same way that you are. But if you are, again, you just want to know, can't fight the urge, then after you check the portal, give them a call. If over several months your issue is not resolved, the Department of Education has set up a reconsideration portal online for borrowers to submit a request to have their accounts reevaluated. And you can submit a request through studentaid.gov. In the most extreme cases, and this goes for student loans or any other type of financing process or product that you have used, if your issue cannot be resolved with the lender or the servicer, then you can always file a complaint with agencies like the Consumer Financial Protection Bureau. You can visit them online at consumerfinance.gov. Also, the Office of Federal Student Aid through the Department of Education has an ombudsman, and there are also ombudsmans, at the state level. There's one here in Maryland. I know there's also a student loan ombudsman in the District of Columbia. So give it some time is my first recommendation, but also check for updates online. And if you feel like something is extremely off and your issue is being ignored or not resolved, you definitely want to make sure that you're advocating for yourself to move the process forward. All right. Let's move to the next question. I work for a qualifying employer, but I have been furloughed. Does my employment still count for public service loan forgiveness? So a bit about qualifying employment for PSLF. PSLF requires the borrower to work full-time directly for the qualifying employer. I have employers there in case a person has multiple part-time jobs through which the hours can be combined to achieve what would meet the definition of full-time. Full-time is the greater of the employer's definition of full-time, or 30 hours per week on average, whichever is greater. For those of you that have multiple part-time jobs, if both jobs are for qualifying employers and you combine the hours to reach that 30-hour per week mark on average, then you have met the definition of full-time for the purposes of PSLF. If you are a full-time employee with one job, then full-time for you would be either the greater of the employer's definition of full-time or 30 hours per week on average. As for a furlough, this truly depends on the nature of the furlough. I have some colleagues who have worked in organizations where the furlough might mean that they have one day off per month or a couple of days off in 1 month, but they're not dropping from a full-time to a part-time status. And for public service loan forgiveness, that full-time status is what you need to meet for the employment to qualify. So in the case of public service loan forgiveness, if you have been unemployed due to layoffs or your hours have been reduced to less than full-time, then payments that you've made during those times or those months of repayment would not count if you are unemployed or if you are working less than full-time. Now, again, about the furlough, if your furlough meant that, for 1 week, you worked less than 30 hours, that 1 week out of a month does not make you, officially drop down from a full-time employee to a part-time employee. But if we're talking about a furlough where you have gone from working 35 hours a week to consistently working 15 hours a week, that's different. You've crossed the line from full-time to part-time. Or in the case of being totally laid off, if you're laid off, those months of repayment will not count toward PSLF. Fortunately, you wouldn't lose credit for any payments, periods of repayment that you'd earned credit for while you were working in a full-time capacity directly for that qualifying employer. It's just that during the periods of unemployment or working less than full-time, those particular months of repayment would not count. All right, next question. About 5 months ago, I received a letter saying that I was eligible to receive 70 months towards my loan forgiveness. I haven't heard anything yet. No one will talk to me or assist me with this process. That is an unfortunate experience, and I hope that that will change for you soon. I just wanted to share with you some information about the payment count updates, because I noticed in the question, you mentioned that you received the borrower mentioned that they had received a letter about 5 months ago. So I went to the website for Fed Loan Servicing, and that is the company that is currently charged with the PSLF program. And according to their website, here's the text. If notified before February 7th of 2022, the update may not fully reflect the implementation of the limited PSLF waiver. We are actively working with the Department of Education to implement the waiver, and over the next 2 months, borrowers should begin to see updates to their qualifying payment counts. So this question actually came in yesterday on the 26th of April. So if we're looking at 5 months back, we're talking about late 2021. So there is a very strong possibility that the payment count that you've received is not up to date. A piece of this question that came in from the borrower was cut off. The end of it said, I've been a public servant for 30, and I'm going to just go with the assumption that the borrower is saying 30 years. So if the borrower has been working for a qualifying employer for 30 years, then the employment after October 1st of 2007 would be qualifying employment for the purposes of public service loan forgiveness. So if they met the full-time standard, they're working for a qualifying employer ever since October 1st of 2007, that means that they're almost 15 years into having the qualifying employment. The next thing that would have to happen is the servicer and the Department of Education would go back and look at the repayment status history of that borrower's loans. And then they would look for months where those two things happen. The borrower was working for a qualifying employer, and the borrower had loans that were in a repayment status. The borrower did not mention the types of loans. So if these are direct loans, the borrower would not need to consolidate for them to become eligible for PSLF. And since there's already a count of 70 that was included here, I'm going to assume that these are direct loans. So if they're direct loans and the letter was received prior to February of 7th, then it could just be that the servicer has not revisited updating that payment count under the rules of the limited PSLF waiver. So my follow-up actions that I would suggest are: 1, logging into their online portal at myfedloan.org, check for updates to the payment count screen. And on some accounts, you may see a note that says that the payment assessment is still in progress. That means they're still working on it. In this case, since the borrower has not heard anything in 5 months, if the borrower has already gone on to myfedloan.org, looked for updates, has not seen any, then I would strongly suggest picking up the phone and making a call. You, like I said before, will probably have to wait a while because hold times can be lengthy. There are a lot of people who are going through this process and want updates sometimes frequently, but give the servicer a call and ask. Again, if your issue is not resolved, if it's been several months, you see no updates, you're not getting responses to your questions, you can't seem to get a resolution, then I would suggest submitting a reconsideration request through studentaid.gov. And again, if you are not being treated well as a customer, and by that I mean your queries again are not receiving a response, then that's when you really have to advocate for yourself. And there are several ways that you can do it. One way is to file a complaint through the Consumer Financial Protection Bureau. I would encourage you, though, to stick with the loan servicer first for updates. Try to exhaust all of your options for resolution there. And then if that just does not work at all, you go outside and file a complaint so that you can hopefully get a response within a decent amount of time. All right, let's move on to our next question. My employer is not in the database. Does this mean they don't qualify? So the database that this person is referring to is a database that is included within the PSLF help tool. The PSLF help tool is an online tool that helps you complete the PSLF application. So you can answer a few questions, it will populate the form, and then you can send that form off to your employer for verification. So when you log into the PSLF help tool, the first thing that you'll come across is to search for an employer. And the way that you search for an employer is by using their employer identification number. If you're not familiar with your employer's EIN, you can go to your W-2 form that you use, for your personal income tax return. Look at that EIN and use that as the number that you enter into the PSLF help tool. Once you enter that EIN into the PSLF help tool, you'll hit search for employers. And there are a few different status updates you might see. The one we'd like to see is a little green one that comes up and says eligible. That means that your employer is included in the database and they are an eligible employer for the purposes of public service loan forgiveness. The other statuses you might see are likely ineligible, or no results. If you see no results, there is an option for you to continue filling out the form by manually entering information about the employer. This would include, the employer's name, their address, website, and you can still fill out the PSLF application and take it back to the employer to get verified. The question was, my employer is not in the database. Does that mean the employer is ineligible? The answer is no. It could be that your employer is just not in there. Sometimes this happens for organizations like churches or places of worship because they're treated as charitable organizations, but without necessarily having to obtain that official charity status from the IRS. So if you don't see your employer in there, it could mean that they fall into that category of organizations that are not-for-profit, do benefit the public, but aren't officially a 501c3 tax-exempt organization. So you can go ahead, manually enter the employer, complete the PSLF application, and then take it back to your employer for verification. Now, if you know that you work for a for-profit company, then that for-profit company will not be eligible no matter what you do. If it's a for-profit company, it will not be eligible for PSLF because PSLF is about public service employment, not your role, but the type of organization you work for. And the organizations have to be government or certain types of nonprofit organizations. So for-profit entities will not count. This is a great segue into the next question, which is, I work for a church. Does my employer qualify? So this can get complicated sometimes because of the way that churches and places of worship are treated. So I pulled language for you. I went to the IRS. I went to federal student aid because I wanted to give you the official language on how PSLF works for people who work at organizations that are involved in religious activities. So the first point is from the Department of Education. It says, if you were employed by a not-for-profit organization, time spent on religious instruction, worship services, or any form of proselytizing as a part of your job responsibilities may be counted toward meeting the full-time employment requirement for PSLF. This is significant because prior to July 1st of last year, this was not the case. If you were, say, working for a church, you would be expected to look at the average number of hours that you work per week, and you would have to draw a line between the activities that were spent in religious activities, such as religious instruction, the worship services, and proselytizing. And on the other side of that line would be the activities that are for the benefit of the public or provide a qualifying public service. And if you truly, drew the line between those activities, then some church employees would not be able to say that they met the full-time employment requirement because they did not have at least 30 hours, or their employer's definition of full-time hours, committed to those qualifying public services. But July 1st of 2021, the rules changed. Now, people who work for churches and other religious organizations do not have to draw that line. They can look at all of the time that they spend in their job. And even if those activities involve the religious instruction, the worship services, or proselytizing, if that's a part of your job responsibilities, that time can be counted toward meeting the full-time requirement for public service loan forgiveness. So churches and places of worship, like I said, have some special treatment. And so I pulled language for you from the IRS because the first piece of that, a language from federal student aid, mentions being employed by a not-for-profit organization. And the question around churches is, well, is this organization a nonprofit? So per the IRS, churches, including integrated auxiliaries and conventions or associations of churches that meet the requirements of Section 501c3 of the Internal Revenue Code, are automatically considered tax exempt and are not required to apply for and obtain recognition of exempt status from the IRS. So basically what this means is that a church does not have to file the form to obtain the 501c3 status from the IRS, or 501c3 designation from the IRS. Other organizations that want that status have to file an application. The IRS reviews that application and then makes the decision about whether or not the organization is a charitable organization under the requirements of Section 501c3. Churches are granted that recognition without having to go through the application process. But how this can cause hiccups within applying for PSLF is that the PSLF help tool gives you that first step, which is verifying your employer's eligibility by using their employer identification number. If your church has not filed the application for that 501c3 determination, then it's quite possible that the church will not show up in the database that the Department of Education uses because they don't have that 501c3 designation officially. However, as a church, per the IRS, the church is automatically considered tax exempt and not required to file the paperwork. So if you do work for a church and the church is a nonprofit organization, it doesn't have that 501c3 designation, go ahead and file your paperwork anyway. You will likely have to manually fill in the fields for the employer within the PSLF help tool, but go ahead, complete the application and submit it anyway, because again, churches are automatically considered tax exempt and not required to apply for and obtain that recognition of exempt status from the IRS. So we hear 501c3 a lot when it comes to PSLF. I just wanted to share with you all some more information about what it means to be a 501c3 designated tax exempt organization. So according to the Internal Revenue Code, the organization must be organized or operating for one of more of the exempt purposes set forth in Section 501c3. Those purposes are charitable, religious, educational, scientific, literary, testing for public safety, fostering national or international amateur sports competition, and preventing cruelty to children or animals. So churches fall into that set of exempt purposes because the word religious is there, and so is charitable. So I hope that this has provided some insight for members of the clergy around applying for public service loan forgiveness, because the waters it can be a bit murky because of churches not always having filed the paperwork to receive that official 501c3 designation. So the bottom line is, If you work for a church, if it's a nonprofit organization, but doesn't have that 501c3 designation officially, file your paperwork, file your PSLF application anyway. All right. Next question. I have worked for a qualifying employer, but I don't think I'm anywhere near 120 months of payments. Should I apply for the waiver? This is an excellent question, and I'm going to show you an example as to why you should apply through the waiver. The waiver is not just for people who already have 120 months of loan repayment history or 120 months of qualifying employment. It can help people who have less than 120 months get closer to the 120 months that are necessary to achieve public service loan forgiveness. So in this example, we have Jen. Jen has worked for a qualifying employer for 6 years and paid on her direct loans under the extended fixed plan for 70 months. So under the original rules of PSLF, the extended fixed plan does not qualify for PSLF. The extended fixed plan is actually a plan that lasts up to 25 years, and the payments do not qualify for public service loan forgiveness. So if Jen were to submit an application for public service loan forgiveness under the original rules of PSLF, then she would have 0 qualifying payments, because even though she paid for 70 months, she had not been enrolled in one of the qualifying repayment plans. So none of that history would matter. She would have 0 qualifying payments and 120 remaining qualifying payments to go. The only way for her to get on track to begin earning toward those 120 remaining qualifying payments would be for her to change repayment plans. She would have to leave the extended fixed plan and enroll in a qualifying repayment plan to begin making progress again toward that 120 monthly payment mark. Now, under the rules of the waiver, the payments that were made under the extended fixed plan could count as qualifying payments. So Jen would go from having 0 qualifying payments to having 70 qualifying payments. She would go from having 120 remaining qualifying payments to just having 50 remaining qualifying payments. So if you take a look at the bar graph on the right, this just shows you the difference that the waiver can make for someone who has less than 120 months of work and repayment history, of work for a qualifying organization and repayment history. Again, without the waiver under original PSLF, Jen would have 0 qualifying payments, and she'd have to work for a qualifying employer for a minimum of another 10 years and make payments throughout that entire time to apply for consideration through PSLF. If Jen applies through the limited PSLF waiver, then the rules will look backward at the payments that she's already made on her direct loans, and she would get credit for those payments regardless of the repayment plan that she was enrolled in at the time that she made those payments. So if Jen wants to make good on this and get credit for those 70 months of past payments, the first thing she should do is submit the PSLF application by October 31st of 2022. The limited waiver is set to expire on October 31st of 2022. So if Jen wants to get credit, she needs to submit that PSLF application by October 31st, and I would recommend submitting it sooner rather than later. The second thing that she would want to do is make sure that when repayment resumes, she is enrolled in a qualifying repayment plan so that her future payments will count toward PSLF. This is really important because the waiver is set to expire October 31st of 2022. And after the waiver expires, the original rules are expected to go back into effect. Now, things could change, but I would rather you err on the side of caution and enroll in one of the qualifying repayment plans, just so that this gain of 70 qualifying payments will continue to grow and reach the 120. And you need to be enrolled in a qualifying repayment plan for those future payments to count. So hopefully those of you that have less than 120 months of either the loan history or the employment history or both can see that the waiver can work for your benefit as well. It's not just for people who already have the 120 months of qualifying employment and loan history. For those of you that have less than 120, the waiver can help you get closer to meeting the mark. So I'm going to take a quick look at the chat. I don't see any additional questions in the chat box or on Facebook. So I'm going to move forward with a very quick overview of those original rules, because in that last example I showed you, Jen, her first step was to file the PSLF application to get credit for the 70 past payments, but she would also need to take some action to make sure that she gets credit for the 50 payments that are remaining. And once repayment scheduled right now to resume after August 31st of 2022, and the waiver is set to expire on October 31st. So after the waiver, if the old rules go back into effect, this is what it will look like. 5 requirements for PSLF. The first one is 120 qualifying payments. Those are made monthly. Second is that the payments can be made on direct loans only. Third, you have to be enrolled in a qualifying repayment plan when those payments are made. Fourth, you have to be working for a qualifying employer for the 120 months. And fifth, you're expected to remain working for a qualifying employer at the time that you submit your application for PSLF and at the time that you receive PSLF. Looking at the time, I've got about 14 minutes. Make that 13 minutes. It will take me a while to get through each of these requirements in depth. So I'm going to zoom through those so that we can get to the screen that shows you all the differences between original PSLF and PSLF through the limited waiver. So the first requirement is qualifying payments. You got to have 120 monthly payments. There is no way to speed up this process. One quick note I want to make is that the payments do not need to be consecutive. So you are not expected to take one job with a qualifying organization, stay with that organization for a whole 10 years, then file for PSLF, get PSLF, and then be free to go. You are free to move between different employers. If you want public service loan forgiveness, those employers need to be qualifying employers for the purposes of PSLF. And anytime where there's a gap, if you're between jobs and have a break, or if you go from not-for-profit to for-profit, you wouldn't lose credit for the payments that you've already made. You just wouldn't gain any additional credit until you return to a qualifying employer. Quick note about the CARES Act forbearance. Many of us haven't had to make payments since March of 2020. And for those of you that are employed by a qualifying employer during this CARES Act forbearance, these months of zero payments should count toward the 120 necessary for PSLF. So that's more than 2 years worth of not having to make payments. And those months can count toward the 120 that are necessary for PSLF as long as you got the qualifying employment during that time. The second requirement is qualifying loans. All direct loans qualify for public service loan forgiveness. If you have direct parent plus loans, there's a little bit of extra work you have to do to get on track for public service loan forgiveness, and that involves consolidating your direct parent plus loans into a direct consolidation loan and then choosing an income-driven repayment plan. But if you're a parent, that repayment plan is chosen for you. It's ICR, the Income Contingent Repayment Plan, which takes me to requirement number 3, the qualifying repayment plans. All income-driven repayment plans are qualifying plans for the purposes of PSLF. The 10-year standard plan also qualifies, and any other plan for which the monthly payment is greater than the 10-year standard plan payment will qualify as well. That last bullet doesn't happen too often, so if you want to play it safe, enroll in an income-driven repayment plan, because those types of plans are most likely to yield a balance for forgiveness. And again, if you're a Parent Plus borrower, the Income Contingent Repayment Plan is the only income-driven plan available to Parent Plus loan borrowers. For requirement number 4, please remember, it's the type of organization that you work for that matters, not what you do. So where you work matters more than what you do. If you are a facilities crew member, if you are a cashier, if you are a teacher, does not matter. What matters is where you work. So the type of organization you work for, the organization that cuts your check, that's what matters, what type of organization that is. Organizations that qualify include government agencies. That could be federal government, state, county, city, local, tribal agencies. Those are qualifying employers for public service loan forgiveness. Also, 501c3 tax exempt organizations, as well as other not-for-profit organizations that provide qualifying public services. You can find the list of public services that qualify online at studentaid.gov/PSLF, or look at the actual PSLF application. There's a list of services that you can search through. And if your employer is not a 501c3 tax exempt organization, but provides those services and is a nonprofit of some type, please do go ahead and submit your application, but only after you've verified that your employer is a not-for-profit organization and provides one or more of those qualifying services. As I mentioned earlier, public service loan forgiveness requires full-time employment, and full-time means the greater of your employer's definition of full-time, or 30 hours per week. If you're a part-time employee with multiple jobs, those hours can be combined to meet the 30-hour per week threshold. And we just spent some time on the PSLF for clergy members. Remember, hours spent in religious instruction, worship services, and proselytizing can count. That rule became effective July 1st of 2021. The fifth requirement is about employment and timing. Borrowers must work in a public service career when their PSLF application is submitted, and also at the time that loan forgiveness is received. Now, after going through all of those 5 requirements, you can imagine that it's very difficult to meet those requirements. And as a result, the public service loan forgiveness had a rejection rate of 98%. A similar program was created to improve outcomes for borrowers seeking public service loan forgiveness, and that was called the Temporary Expanded Public Service Loan Forgiveness Program. Unfortunately, that had a similar rejection rate, hovering in the high 90th percentile. But something happened last October. It's called the Limited PSLF Waiver. Prior to the waiver, about 16,000 borrowers were able to have their debt canceled through public service loan forgiveness. That's 16,000 out of about 1.3 million that applied. Since this waiver went into effect in October of last year, between October of 2021 and the end of February 2022, 83,000 borrowers have been approved. So if you see those numbers, you know something big happened. And that big thing was the limited PSLF waiver. So I want to make sure that you see the differences between PSLF under the original rules and the limited PSLF waiver rules. We went through the 5 requirements of PSLF. 1 is having made 120 monthly payments. 2, on direct loans only. 3, while in qualifying repayment plans. 4, while working in public service for a qualifying employer. And 5, while remaining with the qualifying employer at the time that you apply for and receive PSLF. On the far right, you see the limited PSLF waiver. That first requirement now is not 120 monthly payments, it's 120 periods of repayment, because the Department of Education isn't even looking at how much you paid or when you paid. They're looking at how many months of repayment history your loan has. How many months has your loan actually been in a repayment status? So it's not the payment itself that matters, it's the status of the loan that matters. And the only requirement remaining is that for those periods of repayment, you were working for a qualifying employer. So any months in the past where you have qualifying work experience and a federal student loan and repayment could count toward the 120 that are necessary to achieve public service loan forgiveness. So how can you get in on this waiver? Let me show you. There are 3 things to consider. The waiver, of course, is a time-sensitive opportunity, and it helps borrowers who work or have worked directly for qualifying employers after October 1st of 2007. There are 3 things that I'd ask you to consider. First is knowing your loans, because knowing your loans, the kind of loans you have, will determine your next steps. The second is that you have a decision to make. Some borrowers will have to decide whether to consolidate in order for their loans to become eligible through the waiver. Third, this is for everyone. If you work for a qualifying employer, you have to certify your employment, because certifying your employment lets the Department of Education and their servicer know that you are interested in applying for public service loan forgiveness. So to certify your employment, also to figure out your loans and consolidate, you can do all of that at studentaid.gov. And if you're interested in taking advantage of the waiver, you need to complete any applications and submit them by October 31st of 2022. So let's walk through some resources that you can use as you ponder those decisions about next steps. First, when it comes to viewing your loans, consolidating if necessary, and completing the PSLF application by using the PSLF help tool, you can do all of that online at studentaid.gov. You'll log in using your FSA credentials. You can view your loan types. When it comes to viewing your loan types, what you're looking for is the name of the loan. If the loan has the word direct in it, you do not need to consolidate. The loan is already one that qualifies for public service loan forgiveness. If you see loans that do not have the word direct in their title, if you have FFEL loans or Perkins loans, for example, those loans would need to be consolidated to become eligible for public service loan forgiveness. So you have to view your loans. And once you see the kinds of loans you have, you'll know whether or not you need to consolidate. And if you have to consolidate, you can complete that application online for free at studentaid.gov. And your third step, of course, would be to certify your employment by submitting the PSLF application no later than October 31st of 2022. So studentaid.gov is where you can complete all of the paperwork. The second resource I'd like to share, of course, is the Maryland Center for Collegiate Financial Wellness. We are online at mccfw.org, and we have created a special page dedicated to spreading the word about PSLF and the limited PSLF waiver. That webpage is mccfw.org/MDTAPS, and MDTAPS stands for Maryland Telepublic Servant, because we are committed to spreading the word to every Marylander about this life-changing opportunity to get closer to having the remainder of their debt forgiven. The next resource is the Institute of Student Loan Advisors. They provide free student loan advice, and you can visit them online at freestudentloanadvice.org. If you are seriously pursuing PSLF or PSLF through the limited waiver, I highly encourage you to take a look at Reddit, the PSLF mega thread. That thread includes real-time experiences from borrowers who are applying right now, and you can see the types of response times, the actual responses that they're receiving regarding their applications. So just remember, this is an evolving process. The waiver just went into effect in October of 2021. So there are a lot of things that are happening, and the borrower experience is evolving. And if you want to know what it looks like in real time, again, I highly recommend that you visit that PSLF mega thread on Reddit. Also, tonight we didn't spend as much time walking through step-by-step analysis for applying through the limited PSLF waiver. If you're interested in that, the Student Borrower Protection Center has put together a website. It's forgivemystudentdebt.org that can walk you through every piece, viewing your loans, completing the application to consolidate, deciding which loans to consolidate. You can find a great step-by-step guide if you visit that website, which is forgivemystudentdebt.org. And I just also wanted to share with you a success story to wrap this up. And this is from a Marylander who recently had their debt forgiven through the limited PSLF waiver. It says, I recently had my loans forgiven. I was very skeptical and not very hopeful about my chances, given all the rules and caveats from early Department of Ed administration of the program. I was ecstatic, still am, when I received the letter stating that my obligation had been fulfilled and I no longer owed anything on the loans. It's a definite game changer for me, and I'd guess the same is true for most other beneficiaries. So I'd like to leave on that note of a success story, because I know that there are many people out there who are looking at this and saying, you know what, I don't want to do this again. I've already applied. I've been rejected. I don't feel like dealing with the paperwork. This is no different than the times before. But I want to just remind you of those numbers that I shared with you earlier. Between late 2017 and late 2021, we had about 16,000 people approved. Between October 2021 and February of 2022, we've had 83,000 additional borrowers approved for PSLF. That means that their debts were wiped free, tax-free. So if you feel that you have that qualifying employment, you have some repayment history, I encourage you to submit the PSLF application, because there's no harm in submitting an application and being considered. If you don't submit an application, then you have sealed your fate. It's not an option for you. So I encourage you. I know that it can be discouraging, but in this case, I think that exploring the option will be worthwhile. So please do complete that PSLF application if you meet the requirements. Perhaps some of you will have forgiveness as soon as your application is approved. For others of you, you'll get closer to the 120 payments that are necessary to achieve public service loan forgiveness. I know I have gone just a minute over my time, so I want to thank those of you that joined me tonight via Zoom and Facebook Live for this, the April 27th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. We'll be back in the month of May for 2 more sessions. You can visit mccfw.org/events to take a look at our events calendar. You can register and submit your questions through the Zoom registration process for the next edition of Office Hours, or you can just join us again on Facebook Live and interact with us in the chat. I thank you so much for your time, and until next time, I wish you well.